Good morning and welcome to today's webinar brought to you by Antipodes. I'm Matt Dell from Pinnacle Investment Management, the distribution partner for Antipodes Partners. Antipodes recently celebrated its 2-year anniversary and has enjoyed very strong growth in that time. Funds under management now exceeds $4.2 billion and the investment team is 13 strong. Today's presentation is brought to you by Antipodes founder and Chief Investment Officer, Jacob Mitchell. Jacob's presentation addresses the implications for portfolios in the current low volatility environment and how Antipodes is positioned for this. Before I hand over to Jacob, please note that you can ask questions as we go along by clicking on the Questions tab on your screen. And now, over to you, Jacob.
Thanks, Matt. Brief introduction to Antipodes Partners. We're a global asset manager offering a pragmatic value approach. We seek to take advantage of the market's tendency for irrational extrapolation, identify investments that offer a high margin of safety, and build portfolios with a capital preservation focus. We do this via 3 major levers: our longs, our shorts, and currency management. So to set the scene for today's presentation, our first observations relate to the economic environment. We don't have a strong view on the long-term direction of rates. However, it would seem to us, based on some very long data sets going back to 1930, that European long-term rate expectations seem very low relative to current inflation and growth. We would argue that rates should be cyclically higher in the regions of the world where monetary policy is still very loose, such as Europe and Japan. Now, as Eurozone political risk recedes, as does the logic for emergency type policy settings, the ECB, we believe, will normalise policy at some point with broad implications for global liquidity. So what are some of the distortions that this lower for longer policy has created? Well, distortion number 1, we think, is that investors have moved out along the risk curve, chasing yield into assets such as high yield debt, otherwise known as junk bonds. Now, we have the best data available for this asset class is the US, but we would like to stress this is a global phenomenon. It's grown to become almost a quarter of total US corporate debt on issue. Our concern would be that a combination of very high profit margins, a very low base rate, and tight credit spreads really have encouraged low quality corporates to borrow. And we'll come back later to discuss how that borrowing has been invested. Distortion number 2 is low asset price volatility. Once again, data going back to 1930. Now, we know that volatility is the classic financial textbook definition of risk, but it's only one measure of risk. At Antipodes Partners, we're primarily focused on capital preservation. The chart shows that over 90 years of cross-asset, which means the volatility of bonds, equities, commodities, and also the S&P 500 index, volatility is very low. Now, history shows that the longer low volatility persists, there's a tendency for crowding to take place, and a lot of strategies will introduce higher levels of leverage when an asset class displays low volatility. And that ultimately leads to a more brutal hangover or ultimate market sell-off when that period ends. Now, the lower for longer environment is generating some perverse outcomes in global markets, probably best summarized as a mispricing of duration risk, which is distortion number 3. Over a 30-year period, we have calculated the change in dispersion across certain factors, a measure of how cheap or expensive a certain style exposure is in equity markets. What clearly stands out is that investors are herding into low volatility and high profitability stocks, and paying a very high multiple for this type of exposure. However, low volatility in a share price or an index does not necessarily mean low risk. At the same time that price dispersion or volatility is very low, multiple dispersion or PE dispersion is near a 16-year extreme. Now, let's quantify the world on a sector and regional basis. Equities again across a 30-year time horizon. This time we use colours to indicate what's relatively expensive or cheap versus its history versus the global equity market. The standout expensives are the global defensives. So they tend to be those sectors which do have, on average, defined by profitability, some of the more profitable companies. It includes staples and then the other sector standout is North American infrastructure, which is a great example of leveraged yield. Now, what do we mean by leveraged yield? It's a style exposure that is expensive. Well, very simply, this chasing into yield has allowed infrastructure companies to refinance debt and basically term out their debt at very low rates. So it is an example of crowding into a duration asset class. And it basically increased payout ratios to the point that they can, in selective situations, pay out more than they're earning in terms of cash flow. So leverage yield has become quite expensive, whilst cash-funded dividend yields have actually become quite cheap, which takes me to global communications. You can see there, this sector is persistently cheap across the world. Now, there may be some very good reasons for that. So we should be careful how we use that term cheap, but it's certainly derated. Also, energy is a cyclical that has been left behind. And financials, which is a sector we've been talking about for some time at Antipodes Partners, as being cheap. So our first example of how to navigate this low volatility environment comes from the financial sector. We have been invested in ING for some time, and also other European banks, which we believe are coming out of a cyclical downturn in much better shape. We have UniCredit, Mediobanca, and ING represent the core of that portfolio, and it is a sector we believe where you are also getting attractive dividend yields that are paid out of cash flow. Multiple ways of winning we see in these banks is simply a decrease in competitive intensity, a product cycle which is improving in the sense that European economic environment is pretty buoyant. Corporate lending is starting to recover. And in the case of ING, you also have a structural growth story because it is ING Direct is a disruptor in large banking markets like Germany and this local market here. So these stocks have been great performers over the past 12 months, but we still see, relative to underlying intrinsic value, we still see a very large margin of safety and multiple ways of winning. Now, a great example, turning to our next example, a great example of asymmetrical opportunity. Baidu is a classic growth stock, and growth has become, along with profitability or quality, has become a expensive bias, expensive style exposure in markets. But here's an opportunity to buy it in a very cheap company. So Baidu, we describe it as the Google of China. It has had headwinds which have led to a derating in its core search franchise. The cyber regulator in China made it much tougher on Google in terms of registering its customers and making sure that they all passed a certain basic compliance test, which led to a slowdown in their business. The market started to extrapolate that as a structural headwind. And started to extrapolate that the move to mobile search was was becoming a real issue versus the success of Tencent and Alibaba. The recent results would seem to indicate that what happened was more of a cyclical rather than a structural slowdown in Baidu's business. And we believe, you're still paying quite a low, whilst the headline multiple is roughly 25 times. If you put a sensible value on Baidu's investments in video, in C-Trip, and you strip out the losses associated with some of those investments, we think the multiple is roughly half of the actual headline PE for a business that can sustainably grow at 15% plus. And we also think the market will start to value iQIYI and the investments they've made in the Netflix-style video offering that they have in China, where they are the market leader. And number two, we'll start to put some value on investments in the AI autonomous driving platform, which is getting so much headlines in other parts of the equity market, and it has been overlooked in the case of Baidu, where we ultimately believe they become the default autonomous driving platform for China, and also the voice search, default voice search platform, AI platform in China. So a great example of buying a growth stock at a value multiple. Now, I'm going to take you now into and discuss some of the opportunities we see, asymmetrical opportunities we're seeing on the short side. Now, I mentioned a combination of energy being a very cheap sector. Energy is we believe is one of the sectors where you can actually find, because of PE dispersion, which is broad across a lot of sectors and across the market in aggregate, you're getting long-short opportunities in the global LNG and oil exposures. So on the long side, Inpex is a investment that we think is really at that point where the market has been looking backwards at this large investment that they've made in Ichthys, and all these large LNG projects that have happened in Australia have typically had cost overruns and execution issues. The silver lining for Inpex is because of its own sort of delay, some of the delays or the caution that they applied before they pulled the trigger on the project. A lot of the actual implementation took place in a deflationary environment for steel and for contracting labour. So the cost overrun has actually been relatively minor. It's only been roughly 10%. And we are, within the next 12 months, we should see the first gas and oil come out of this project. So you're at that harvesting phase. It also, we think, represents an infrastructure exposure. If you think about what LNG is, it's typically priced off an S-curve versus a cocktail of different commodities, but primarily oil. So you don't get all the upside, but you do get some protection from the downside. We also have very low sovereign risk. The majority of our customers are contracted for a very long term, on a very long-term basis. This is a project that has a 40-year life. And they typically are Japanese and Korean utilities. So we see a very low risk profile for the project, very long duration, in a market where investors are paying up for duration in assets like the staples, like the infrastructure stocks. And yet we can get a 10% cash flow yield here in Inpex for a similar long duration exposure. We think that's quite interesting. Now, on the short side, you've had in the shale, your shale stocks, as you can see there on the slide, valued on a enterprise value to the barrel of oil equivalent. These are some of the most expensive stocks in the oil patch, with EOG being the poster child of the shale, your shale patch. It's almost the opposite to what we have in Inpex, in the sense that all of Impex's capex is behind it, whereas the shale companies have to keep spending just to stand still. Because shale has such a rapid decay rate, you can't stop drilling. And that is, I think, the key issue for the shale stocks is that they have accessed fairly forgiving corporate credit markets in order to fund what are cash flow negative, in many cases, cash flow negative investments, at least in the short term. And the only way they become cash flow positive is to stop drilling. But if they stop drilling, the reason that investors own these stocks is because of growth then starts to decay. So we think the US oil stocks, which have been derating, will continue to derate. And that represents some interesting short opportunities. Now, the next short I would like to discuss is Tesla, which I think Tesla embodies a lot of the style biases that are in play in the market today. It certainly is the growth stock for all seasons. Some investors see it as a luxury brand. Others see it as the new what is the iPhone was to mobile. Tesla is to automobiles. It's also an alternative energy battery storage company. Now, when you step back, at the end of the day, we see it as actually just a very small car company with a very large market cap in a hyper-competitive industry. Tesla, we see as having multiple ways of losing. Even if you want to define the global automobile market today, just in terms of EVs and hybrids, Tesla is a relatively small player with only 3% market share, as we show on the slide, in a market that's dominated by Toyota. Now, we think that is actually being kind to Tesla. You should define the market in terms of total cars. The move to electric vehicles will be gradual. It won't be, we don't believe there'll ever be a step change unless the oil price was to double. There are the energy gains that batteries make tend to be incremental, and there's still a long way before full EVs become cost competitive with the internal combustion engine platform. And all of the major OEMs, like Toyota, like BMW, Hyundai, you name them, they all have EV programs. So they're not just standing by allowing Tesla to take this large leap forward in a non-competitive environment. So what the company has achieved to date is fantastic. However, it is at that point now where it needs to scale. And I think that is going to be a difficult proposition for Tesla. And there is no margin of safety here because the business is currently valued at an EV to sales of 7 times. Look, we know it's not making any money, so the PE is not that relevant. But this is in a sector that is globally very, very cheap. The market is pricing its competitors at very low valuations. Companies like Hyundai, like BMW, are very cheap. So Tesla has to get a lot right in order to justify its $60 billion valuation. And it has been a key beneficiary of very forgiving credit markets. Similar to the US shale patch, Tesla has been able to tap credit markets to fund its business model, which remains loss-making. Roughly $1 billion a quarter is being burnt. So they have to keep investing, and they will. It's a question of what price you pay for that opportunity, and that's where we see asymmetrical risk to the downside. Finally, on the next slide, just a very quick overview of our current sector and geographic exposures. As you can see in North America, it remains our largest geographic exposure, but with a concentration in globally exposed companies as opposed to domestically exposed companies. In Western Europe, it's the opposite. We want to be exposed to the Western European economy. we think there's great opportunities in European banks, in European utilities, in European telecommunication stocks. These stocks are mispriced versus their comparable companies in the US and other parts of the world. When we go to developed Asia, which is Japan and Korea, it switches a little bit back the other way. It's primarily global companies. So in Korea, we own Samsung, Hyundai Motors. In Japan, Panasonic, which is obviously, has a small part of its business exposed to Tesla, but a very, quite controllable in terms of risk. Then when we go to developing Asia, which is primarily China and India, it swings back the other way, where we have mainly domestic exposures, even in the ones that are classed as global, being the staples. They primarily Chinese staples that are Chinese companies. So you could describe those companies as being domestic as well. You can see some of the transition in the last 12 months in the net exposures in the final two columns. And you can see that our net exposure has remained roughly stable at about 60%. Finally, just looking at, just summarising today, because of the lower for longer type environment, we think investors are generally overpaying for long duration exposures in equities, and companies that have nearer term cash flows are generally cheaper than those that have cash flows that are long dated. If there is a cyclical uptick in rates, especially in Europe, especially in Japan, those long-dated cash flows are most sensitive to those moves, and hence they are the parts of the equity market that we believe have asymmetry to the downside. Whilst there's a big focus on low volatility, price dispersion is low, multiple dispersion is very high. And ultimately, we believe that should lead itself to be able to stock pick interesting opportunities in markets. And we have our three levers, our long, shorts, and our currency management to take advantage of that.
Thank you for dialing in, and have a good day.